Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoy this episode. Thank you for joining us. Well, hello, this is Hall Martin with Investor Connect. Today we're here with David Mess of Off the Grid Ventures. David, thank you for joining us.
Oh, thank you, Hall. It's a pleasure to be here.
So can you tell us a little bit about what led you to your current role in early stage investing? What did you do before and how did you get to where you are right now?
Yes, well, I was lucky enough to fall into it pretty early in my career. I had a short entrepreneurial stint in which I raised some angel investment. I quickly realized the venture wasn't going to go anywhere, so we actually returned the commitments, the capital, if you will. And at that time, I thought the other side of the table was really exciting, and I joined an early stage firm back in Europe. My timing was perfect. I started on March 1st, 2000, so pretty good weeks before the market went down. So it was an exciting time.
That must have been a very tough time watching it come at the very top and then reset to a new standard.
It was, and it was even tougher at the time back in Europe where we had a dry bubble before we had the nuclear winter, as we called it there. So it was pretty tough, but it was also a great time to learn and understand investing much better. If you learn how to do it in tough times, it becomes easier to do it in good times as well. And you also understand the cycles better and are ready to plan for them. And it actually influenced a lot of my career. So for about a decade, I took a detour out of early stage and pursued somewhat later stage investing themes, doing secondary direct purchases. So basically buying stakes from VCs and corporate VCs who had been in companies for too long and needed to exit before they had an actual IPO or trade sale, which would have been a more traditional route. Did that for a while. Saw a few years back that the valuations in anything late stage were increasing fast and in some cases becoming unreasonable, and decided it was the right time for me to get back to early stage venture, which I did about 3 years ago.
So let's look at where you are today with Off the Grid Ventures. What is your fund focus on? Yeah,
so our objective is to basically back overlooked and yet overperforming entrepreneurs. So those are the quote-unquote off-the-grid entrepreneurs by Silicon Valley standards. And we focus specifically on companies that are started by either female founders or foreign founders. Both these groups have a harder time raising capital initially, and yet they statistically do better in the long run. And so we help them by connecting them to all of the resources Silicon Valley has to offer, be it channel partnerships, talent, venture capitalists, and so on and so forth, so that they can succeed. So basically, we make that bridge between that world they aspire to but didn't have full access to yet, and their ideas and the ventures they've started effectively.
So when you get it started coming in the door, what exactly are you looking for in this case to fit your investment thesis?
Sure. So first I should state here that we invest specifically in B2B technology companies. So a lot of what I'm saying is really geared towards that. Don't ask me about biotech or even B2C. Those are not areas we specialize in. So obviously the first thing we look at is the quality of the idea. We also want to understand if the market is attractive enough. Is it big enough? Are there fundamentals? Is there a real pain point that need to be addressed such that it makes sense to enter there? We then look at the plan the company has. Is it a coherent plan? Is there a logical step-by-step approach to building something? Sometimes the plans we see are very static. So if that's a piece of advice for entrepreneurs, don't just describe the end goal with all of the pieces. Also describe how you move from one step to the other and why you're starting on one side rather than the other. For instance, if you build up a marketplace, and how do you do this effectively? And so we're really looking for something coherent. And then last but not least, we look for a great team. Everybody says they look for a great team, but it's not always clear what it means. That's a question we're absolutely passionate about, and we're constantly looking for ways to identify the best teams. We know that because of who we are, we have biases. All of us have biases, and we try to erase those to some extent so that we're able to identify great teams that are not right up our alley effectively. We leverage our experience and our knowledge, but we also leverage some machine learning tools to identify the best teams, and that's been quite helpful to us.
So how did you arrive at that investment thesis, and how do you know that team has really got the criteria that you're looking for? How do you figure that out? What questions do you ask to assess that?
Right. So the overarching thesis behind our investment focus is really that diversity drives returns, right? And so actually, if we see a very homogeneous team of female founders or very homogeneous teams of 5 people coming from the same country looking at things in exactly the same way, we might actually not like that as much, right? We'd like to see teams that are diverse in and of themselves. And so we really look for that. We know that you can have 5 very talented individuals, and yet as a collection, they don't work well together. And we know you can have 2 great individuals and 3 average ones, and yet that as a team would function extremely well. So we try to understand the dynamics early. What we're looking for is people who generally trust each other, people who have very complementary skill sets, and who respect what one another bring to the table and are not constantly stepping on each other's toes, right? And so that's a dynamic that after a few meetings, you get a pretty clear idea about. Because initially, you probably meet one of the entrepreneurs and you see 2 or 3 in a meeting. And as you go on in the interactions, you see whether it's really team play or whether what a single person is dealing with everything and kind of dictating to everybody else, which typically is not the right way to go.
So you've seen a lot of early stage companies come and go. And what would you advise early stage investors to do in order to be successful at early stage investing in general? What's your main thesis?
Right. I would say 3 things, and I'll tackle them by order of importance. I mean, the first one, obviously, try to pick the right companies, but that's what everybody comes in trying to do. But, try to be somewhat disciplined at it and understand why you're focusing on certain things and others. What are your own blind spots? How can you correct for those, notably by aligning with other people who pursue investments too, but who have complementary backgrounds and visions to what you bring to the table. The second one is to also apply discipline in the way you negotiate investment terms. Of course, valuation is important, but it's not necessarily the most important thing, but you should pay attention to that. Because if you systematically overpay, well, then your returns will be diminished, right? There's no way around it. Now, there's other terms, though, that are important. And in particular, you want to make sure that you have follow-on investment rights. Because if you're in a company that's doing extremely well, but you cannot load more capital behind your initial thesis when it's doing well, or you cannot even protect yourself if you hit a difficult circumstance and there's a pay-to-play around or something like that, then your portfolio as a whole is going to be hurt because you're basically not going to be able to skew the portfolio towards the winners, and you're not going to be able to protect yourself in difficult situations and salvage what is possibly a very good investment, but it's just going through a tough time. And there's always a lot of those in economic downturns. So that really would be the second point. Try to make sure you negotiate your legal rights properly when you enter companies. And the third point is, don't look just at investing in companies, but look at building a smart portfolio. And what I mean by that is, you can be investing in a few great companies and yet not make any money on your overall portfolio if you don't have a proper fund strategy. To have a proper fund strategy, what do you need? You need proper diversification, which is obvious. And yet you need enough reserves to protect your portfolio in the long run. So you need to have basically calculated the size of your average checks based on the capital you have available for the effort, and make sure you have plenty in reserves in spite of trying to diversify. So that's really important. And if your checks are too small, then you may want to consider joining up with other people. Then you'll carry more weight and you'll also be able to distribute the work, as stated before, and have complementary experiences come to the table. You want to make sure that in the way you manage it, you can make money at a portfolio level just from the core of your portfolio. Companies doing well, but not great. Of course, you want to have the outliers and the home runs, but you cannot solely rely on those to make capital. There's a thesis in Silicon Valley that goes around it. It's all about the power law of returns. And that's true to some extent, but it doesn't need to mean that you would lose capital if you don't have the big home runs. You should be able to earn money on a portfolio level, just in the singles and doubles, and then the home runs will get you further. And most importantly, you need to know how to withstand a downturn, right? And that comes with experience, of course, but it comes first and foremost with having sufficient reserves, again, to invest and protect your companies, protect your stakes over time. It's really a hard needle to thread, but if you don't plan it up front and track it closely, you're very likely to slip, especially in a downturn. So really our motto here is luck favors the prepared. Think about it not just on a company-by-company basis. Don't just get excited by new shiny objects, but think about your overall portfolio and how you balance risk across that.
Well, that's interesting or timely advice in the sense that we're almost 10 years into a bull market run. And most markets don't last more than 10 years. And of course, there's always things on the political front that could change that. What do you think investors should be doing today specifically to look for the next downturn, which historically would be coming up in another year or two?
Yes, or in a week, who knows, right? But absolutely, I think there's 2 things you can do, right? The first one is to prepare all of your existing portfolio companies and make sure you have a conversation with them not necessarily to try and reach break even right away, but to know how they could get to break even or close enough that the funding needs they would have in case of a downturn are not too important, right? And you need to know what that plan B is at this point in the cycle. Otherwise, you could really, really hurt, because if people aren't prepared and don't know what to do, you're going to lose a couple months, and that's too much capital to actually waste in a difficult situation. The second thing, again, is really look at your portfolio more from a financial standpoint and think about, okay, how much capital have I deployed? What are my best performers? How much money do I have to protect these, and how much money do I have to protect my stakes or follow on in the rest of the portfolio? And is this sufficient? And if you start fearing it's not sufficient, maybe you stop doing new investments and make sure that any money you set aside is then ready to protect these stakes, right? Especially if you're angel investors, and depending on your cash flow to keep on making investments, be careful not to take on too many, because at some point you won't be able to support the whole portfolio. And in a downturn, that will hurt you more than if you had a maybe less diversified portfolio, but one that you can sustain.
Your background had you at one point buying deals from venture capital funds that had to go ahead and close down, and they needed to sell off what was left in the portfolio. So it seems like there are alternatives to going public or going M&A, that you can actually sell your investments to other investors. What's your take on that? Do you think there's any real money there, or is it 10 cents on the dollar, you don't really make any money, you just save a little bit? How much choice do people really have when it comes time to sell off assets or positions in companies where it's time to move on?
Well, it depends on the quality of assets, and it depends on the urgency that the seller has, of course, right? So you want to put yourself in a position where you have time to negotiate and, to talk to different people and not expose yourself to just getting, as you said, 10 cents on the dollar. And then it comes to the quality of the assets, right? If you have some quality assets, you may want to think about disposing of one of two of them along with the others that are not as good quality, so that the price of the portfolio as a whole is decent, right? Because most people won't want to take just the middling assets and certainly not the bad ones. Or if they do it, they will take them at very low prices. Now, if you add a couple of good ones in there, you may get a better price for the portfolio that you're selling as a whole. And then if you want to keep another portion of your portfolio, then suddenly that money you've collected from that secondary sale can be recycled into sustaining the rest of your portfolio. But of course, it means as a VC, if you're trying to do this, you need to do it early enough that you don't suffer the melting ice cube phenomenon, right? Don't start getting hurt by pay-to-play rounds and so on, and see the value of your portfolio shrink and shrink before you take action. Because at that point, you have to sell the whole thing. You won't be able anymore to just sell a portion of it and then try to sustain the rest and still be successful on that basis. So you really should go at it early enough.
And so in a 10-year window, at what year do you think that normally starts? Years 3, 4, and 5, or 5, 6, and 7? When do you think people should be looking at that?
At a 10-year window, that would start when? At the bottom of a downturn, or how are you thinking about that?
Well, typically VC funds are 10-year funds.
Oh, for the funds. Yeah, sorry.
So at some point, you have to apply portfolio management. First 3 years, we're investing very heavily. Next 3 years, we're following along. Last 3 years, we're trying to exit.
Yeah.
And so I was just trying to figure out, aside from the economic cycle, which may be offset from that, what should portfolio managers be thinking of in order to, I guess, right-size the portfolio?
Well, I would flip the logic on its head a little bit, right? And not wait until the last 3 years to try and get the most out of it. As I stated about our own strategy earlier on, of course, the home runs are great, but it might actually make sense to try and generate some single, double, triples in years 5 to 8 by selling some of your stakes on secondary basis, even if you don't need to, but just to make sure that your fund is in positive DPI territory, i.e. has returned more than 1x cash on cash. And the reason why you want to do that is because you want to show to LPs that you understand they have a need for liquidity themselves, that you understand there are risks in market cycles, and that you want to make sure that year in, year out, whatever happens, you have positive returns at a portfolio level, and not be the guy who comes back a few years from now and say, hey, you know what, we had a downturn, but look how great I am, because I brought back 70 cents on the dollar, whereas the average in the industry is 60 cents. That really doesn't matter. You still lost money, and quite a bit of that. Yes, it's great to be in the top 1% if you can, rather than just the top 10% in good market times. But it's actually much better to be in the top 10%, the top decile performing funds in every single vintages, by being a little bit more conservative in your investment and divestment strategy. So that's really the piece of advice I would give. And then in terms of when you would look at more defensive sales as well, I would really time it more to the cycle. And of course, it's always a difficult thing to do. But when you feel like a cycle is long in the tooth, like it is now, maybe start thinking about selling while prices are still high. Because I can tell you, as soon as the downturn comes, you may not even be able to find a secondary buyer because everybody will be busy with so many opportunities. And the prices certainly will drop significantly from where they are at today.
Very interesting. So at the height of the market is buy low, sell high. You should be thinking about selling at the height of the market because it could be going down and you can at least pay back your investors their initial capital. So in the final few minutes of our interview, what else should we cover that we haven't so far?
Yes, I think it's interesting to have a look at the VC industry as a whole and how it's changing, because in the coming years, it will be radically transformed as it starts facing some of the structural challenges it has, right? One of the biggest challenges it has is actually its success. There's an emergence of larger and larger funds, which is opening up tremendous opportunities, of course, for a lot of companies who can raise more and more capital and be successful at that. It's also creating a bit of an unnatural competition between companies to have to raise amounts of capital, which frankly they wouldn't quite know how to deploy, were it not by going too fast and maybe wasting some money along the way too, right? And this kind of size growth, and everybody talks, of course, about the Vision Fund and the effect it has on the size of a lot of mega billion funds, multi-billion funds, I should say, are being raised in the wake of that. But the result of that as well is that it's carving out the early stage portion of the market where there's a gap that's being recreated. And so tremendous opportunities for early stage investors, angel investors, seed stage venture funds. There's a lot for us to do where the traditional players had to desert the field because their checks have grown bigger and bigger. And so I think that's really an interesting thing that's happening in the industry. And that's also what opens up these secondary opportunities I was talking about earlier. From the Series B on, you actually see funds who want to place so much capital that they can't really place it on a primary basis. And so they turn around and look at the cap table and say, oh, who's willing to sell its junior shares to me at a price that is the same or close to the price of the senior shares I just invested, I just bought on a primary basis. And at this point in the cycle, those might be very good opportunities to exit. Maybe you're already doing 20, 30 times on your early stage investments. And that's great news. And maybe that's money you should take off the table before the market turns. The other thing I'd like to say about the venture industry, the way it's going, is it will probably start emulating the traditional the buyout industry. In a sense, you will see more and more secondary transactions, but not only for minority stakes, but over time, you will also see these be for control stakes in companies, right? You will see more and more non-strategic buyers providing exits and making this happen. So this is really going to be an interesting thing to observe. And finally, the integration of artificial intelligence and machine learning tools in the ways VCs work. VCs have been placing billions of dollars into AI companies for past 5 years at least, every year. And yet they haven't used much of it themselves for their own investment processes. We've started doing that. We're part of less than a dozen companies that are doing that right now. And I can bet you that in 5 years, it will be table stakes in the venture industry. And I think that will be something absolutely fascinating to follow.
Well, there's so many more VCs now that you almost have to have AI to keep up with the growing number of funding sources that are out there. We see that every day, how many new entrants are coming in with micro funds and other investment theses that it can be tough to keep up with for sure. So I think people will be driven to it just for the sheer complexity of the number of funding sources that have to be cataloged and managed. So I agree with you for sure on that one. What's the best way for the audience to get in touch with you?
Sure. They can go to my website or my LinkedIn profile, of course. And my email address is david@otgventures.com.
Great. Appreciate you having you on the show today and hope to have you back for a follow-up very soon and wish you success with what your new fund will do.
Thank you all. Appreciate it. And it was a pleasure being here. Thank you very much.
Thank you. Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.